Working Man Investor, today's video, how to build a properly diversified portfolio. We've all been told the importance of having a diversified portfolio. While this sounds good, the issue with this advice is it usually comes from financial advisors who convince you to build a portfolio through stocks and bonds and mutual funds that they suggest for a fee. Financial planners have only been around for 40 years. They were created by banks and brokerages around the time the 401k came out and people became responsible for planning their own retirement. It only takes an average of 30 days to become a financial planner, and the diversified portfolio that they push is nothing more than an effective sales pitch that they know the financially illiterate have fallen for. Nearly every financial planner will tell you to be financially secure, you must be diversified. After a conversation with these financial planners, I get people telling me that they now have this great diversified portfolio that's safe for the next economic downturn. When I ask them what they're in, they usually say things like they're in mutual funds that cover the S&P 500, a growth fund, an international fund, a blue chip, and a taht. So what these financial planners never tell these people is this is not true diversification because it's all the same asset class, paper assets, which is also the asset class that these banks and brokers make the most amount of money on. These planners will completely ignore other classes such as real estate, commodities, and business. When everything you're invested in is in the stock market, it doesn't matter if you're in McDonald's and Apple. They all go down when we hit a bear market, or if we have a situation like we just had here in April where Trump just passed all these tariffs, the broad markets are all dropping. So everything that everybody's in is pretty much going down. Actual diversification is investing in multiple asset classes. These classes include real estate. They do include stocks. I'm not against stocks. They also include commodities, gold, silver, cryptocurrencies, and speculative just starting businesses. As an investor, you should build up your portfolio with all of these asset classes and be a specialist in at least once. Now, before I tell you how I did mine, I got to read my disclaimer. I'm not giving investment advice, and this video should be viewed as entertainment purposes only. You can lose money investing, and you should do your own research and not trust somebody you've found on the internet. So what I've learned over the years through investing is that real portfolio diversification can protect me from asset cycles, because all assets have cycles, but these cycles don't always go at the same time. I invest my money in different asset classes. My largest is real estate. Real estate is my passion. It's what I'm an expert in. So what I do is, number one, I have a fairly large rental property portfolio that cash flows and puts money into my pocket every month. The other thing that I do is I do a thing called private money lending. So what that is I have a group of people that flip houses, and I will loan them the money to flip the house for 6 months at a 10 to 12% interest rate. I'll then secure a lien with me in first position against the property in case they don't comply with the contract and get it done and get me paid back in 6 months. I can foreclose on the property. I've never had to do that. And what I do with this is I keep my expenses down. I don't buy a lot of things I don't need. But when I get paid back principal and interest, I continue to loan that money. And that's how I got the ability to buy rental properties. So now that I have built this fairly large portfolio of rental properties, I then begin to look to diversify. So what I did is I then moved into paper assets, into stocks, and I went with an ETF. An ETF stands for Exchange Traded Funds. An ETF is a type of investment that holds funds, a basket of assets like stocks or bonds, and trades on the stock market like an individual stock, only for lower fees. Once I picked the fund, it became passive for me. What I mean by that is I just dollar cost average into it. So the first business day of every month, I invest a chunk of money into this ETF. It does not matter if the stock market is up. It doesn't matter if the stock market is down. It doesn't matter if we're in a recession. It doesn't matter if the economy is booming. It does not matter. Just the first business day of every month, my money goes in there. That's dollar cost averaging. Over time, that's the easiest way to and the quickest way to make money. and to grow that particular asset. So once you have two assets, I then moved into commodities, gold and silver. So now it's very important to understand you should not have a large portion of your portfolio in gold or silver, no more than 5%. Gold and silver are best used to preserve wealth. It's why it's down the line. You don't start off buying gold and silver because you haven't built a net worth yet. You have nothing to protect. So the reason I buy physical gold and silver is because it's a hedge against inflation. I believe if I were to go to my backyard and bury $10,000 in gold and $10,000 in cash, and then in 10 years I dug it up, that gold and silver would have more buying power than that $10,000 in cash, because gold and silver get more valuable with inflation, where cash becomes less valuable. It has less buying power. So it's important, again, to remember that this gold and silver, it's only going to sit there and look pretty. It's not going to pay you a dividend every quarter. It's not going to pay you rent. That's why you don't need a lot of it. You just need some as a hedge and to protect yourself. Next thing that I did is I moved into speculative investments. This can be through the stock market. It could be through a friend of the family that wants to open a business and they need capital and you want equity in that particular business. But again, you don't want to have a large portion of your portfolio in this, probably no more than 15%, because all of these companies, they're just starting off. So they have huge return possibilities. You could make hundreds of thousands of dollars or millions off of it, or the company can go bankrupt and then you lose everything. So again, you want to be really careful here. You don't want to have a massive amount invested in that, and you do not want to start with that being your first investment. You're better off starting probably in an ETF, because real estate has a higher entry point, which means it's just really expensive. Not a lot of people have the money sitting around to go buy a rental property. That's fine. Start off with an ETF and dollar cost average every month. At that point, you're beginning to take your step towards financial freedom. Once you've built up a fairly good amount within that portfolio, within that ETF, and you could be working on that one asset class for 5 to 10 years, especially if you're in your 20s or 30s. There's nothing wrong with that. As long as you're doing that and you're continuing to keep your expenses down and you're still saving up other money to invest, and then after you've built that ETF up or those paper assets up, then start maybe buying some gold and silver, maybe buy a rental property, and then get into a speculative assets. So that's proper diversification. You're in multiple asset classes, not just one, and you're protecting yourself from different cycles within the economy. So that's what I got for you today. Working Man Investor. Keep grinding, people.